Welcome to the Sales Prospector Show, supported by Lease a Sales Rep, an Inc. 5000 company, helping our clients grow sales by securing guaranteed appointments, qualified leads, and guaranteed contracts for their services and products across the U.S. I'm your host, Gil Pagan. You can also find us at leaseasalesrep.com and on all major social media channels. I have the pleasure of interviewing today and having discussion today with Chris Jones. He is the president of Sunbelt Business Advisors that is located in the Twin Cities of Minnesota. He's been buying and selling companies, helping people to do that for the last 20 years. Chris, welcome to the show.
Yo, thanks for having me. Appreciate it.
You're welcome. I'm looking forward to a great discussion on buying and selling businesses and how to do that. I know that we spoke before, and I am curious by nature and have a lot of questions, and clearly you're full of a lot of knowledge and you're a database that can answer these questions for our listeners. Tell us about what you're doing there and at Sunbelt, and how you're putting stuff together for people and getting these businesses bought and sold, and take it away.
Yeah. We help buyers and sellers at the end of the day. Most of the people we deal with, Gil, have entrepreneurial DNA. So a typical client that we would help be somebody who, built a business, started it 20 years ago, maybe a husband and wife team, father-son team, but maybe now they've grown it to 20 employees, 30 employees, 50 employees. They built a lot of value and they're looking to exit. But maybe that son or daughter doesn't have the money to take over, or maybe a bunch of partners own it, right? And they all want to retire. Our job is to help them find the right buyer for that business, right? Help them find the right person to take over their legacy, and often give them a pretty significant wealth event for that business. So I've been doing that for 20 years with Sunbelt. We're the world's largest seller of companies. We're the largest here in Minnesota, and a lot of small and mid-sized businesses, anywhere from $500,000 in revenue, sometimes even less, all the way up to about 100 million in revenue. And then the big investment banker folks take care of the stuff that's bigger than that. We're all privately, closely held companies for the most part.
Wow, and you're doing that in Minnesota, and if my memory serves me right, you're also like doing stuff in Wisconsin or Illinois.
Yeah, memory is right. So Sunbelt's actually a franchise, and we have the franchise rights for all of Minnesota, all of Wisconsin, the city of Chicago, and also Las Vegas. And then we have affiliate offices, other Sunbelt offices across the country, and there's 200 offices now across 11 countries. So Sunbelt has been around since 1978, helping people buy and sell companies. We've been here in the Twin Cities since 2001 now, I think, 2000. Yeah.
Gotcha. So, and can you share a little bit about, I guess, the benefits of buying a business versus growing it on your own, right?
Sure.
Pros and cons, and I got my viewpoints on that issue. Obviously, I built mine from the basement of my house into what we have today. So, but there's benefits to growing it on your own and obviously buying one. So, give us some insight into that.
Yeah. So we kind of it's a great question. We kind of break our business down into two segments: Main Street, which is typically under 5 million in revenue, and most of those, frankly, are under 2 million in revenue. And many of those companies are purchased by high net worth individuals who might be buying their first business, and they don't necessarily want to go do a startup. They've accumulated some wealth. They might be a C-level leader at a company or a VP of, say, a good-sized manufacturing concern, but they've always wanted to have their own company. And rather than start it from scratch, they want to take something over and use their experience of running a larger organization to take that acquisition to the next level, so that they're able to do that and have instant customers, instant revenue, instant suppliers, brand, all those things that make a company valuable.
If I may interject here, Chris, I apologize. I may interject every once in a while. Get some more value out of you. So somebody like that is going to end up spending more money, right?
Yeah.
I'm assuming when you get to the next part of the discussion, versus you building it from scratch and going up. Go ahead.
Yeah, no, that's absolutely right. And some a founder of a business is, this may or may not have been your experience, but it's the experience of a lot of founders. They're going to burn some capital in those first couple of years. They're going to take more risk. It's more speculative. It tends to draw a different type of entrepreneur, a bigger risk taker, right? Yeah. So, we know each other, right?
Yeah, right.
The bigger risk taker. There's different appetites for risk, and we tend to have a sell side client who is that type of person, that they were a founder, they built it from the first employee up to the many employees it has now. The acquirer often tends to be somebody either who owns another company, sometimes could be one company buying another, but often, again, that high net worth individual, or what we sometimes call, and we mean this isn't derogatory in any way, but we call them corporate refugees, right? They want to get out of corporate America, but maybe they've been making, a pretty good living. So they want to make money right away. And they're not afraid to take out an SBA loan or a commercial loan, to make that acquisition and take on some debt to do it, right?
Wow.
They'll leverage their own capital and then maybe bring in an SBA loan as well.
Wow, no, that's great. Thanks for explaining that. So when we talk about the buying of the businesses, right? Whether you're going to build it or you're going to buy it, clearly, they both involve some capital, and starting it on your own and not buying one is going to obviously be, you can try to control your spend, your cash flow, your burn, versus obviously spending the money on the front end to buy something. So talk a little bit about the financing aspects of businesses, one, and two, that the businesses that are being sold, the perception that many of those businesses are in distress, because many are being sold because they want to get out because something's going on. So financing, how do people finance this? And also, are businesses that are being sold typically in distress from a percentage perspective?
Yeah, it is interesting that that's the perception. And we forget about that sometimes as business brokers or M&A advisors. But at least for our firm, we stay away from distressed companies. That's not our, we don't specialize in that. If a client comes to us, they typically have a very healthy company that's making money. And the business is in good shape, but the person is tired. They want to retire. They want to, it's cold up here in Minnesota. They want to get down to Florida, or you're in a warmer state. They want to get to a warmer state like yours. They've had enough Minnesota winters. They want to find a beach somewhere, or they're just sick of dealing with employees. They've made enough money, right?
Right.
And they also probably don't want to grow the business to the next level. So the business buyers ask all the time, if this is such a great business, why do they want to sell it? Well, because they're human beings. They get burnt out, or they want to spend time with the grandkids, or they want to travel the world, or hop in the RV and travel the States, whatever it is.
Sure.
So we personally stay away from distressed businesses. Those can be very compelling investments, but it's a whole different discipline of buying those. You got to be kind of a turnaround artist, in my experience, right?
Right.
So as far as the finance, if I can answer the finance for you.
Yeah.
From a financing standpoint, assuming it is that healthy company, if it's a Main Street business that under $5 million in revenue, it's probably going to be an SBA loan. And the buyer will have to put anywhere from 10 to 20% down of their own money. The seller might carry 10%, sometimes a little bit more. And the bank's likely to come in with anywhere from 60 to 80% of those deals. 80% is quite common on a 10-year loan. And interestingly, right now, with all the stuff going on with like COVID and stimulus packages, those you can get an SBA loan right now, and they'll make the first 6 months payments for you to mitigate some of your risk of, if the business has been disrupted at all. As long as it's cash flowing, it has to show it has the cash flow to service the debt and for the buyer to pull out a reasonable amount of money. Bigger business, I talked about Main Street earlier, but if it's over that $5 million threshold up to $100 million, we call that lower middle market or M&A. Those businesses are probably financed by the buyer's own banking relationships, their own capital, or they're being purchased by a private equity group that has a fund. Right? They've already raised the money. They have the capital. They're going to use their own cash. in those cases.
Mhm.
Those are the bigger boys making acquisitions in those cases.
And the when it comes to the SBA process, my understanding is that sometimes, depending on where you are, what market you're in across the country, it could take months for that, that deal to close. And I've heard sometimes 90 days. I've even heard 120 sometimes to get through an SBA loan. And is that your experience basically or no?
Well, it's all over the board, and here's why. That absolutely happens, and I've seen worse. Um, it's because the buyer picked the wrong bank. So there are many banks who are SBA approved or SBA preferred who really don't want to do SBA, who really don't want to finance business acquisitions. Like they're really good at financing real estate or giving lines of credit to existing business owners, but they don't necessarily like to step out into business acquisitions because they're complicated. They are a little riskier because they're more complex, even though they have the SBA guarantee. So if a buyer picks the wrong bank, it can easily cost them a deal or drag it out. We have a director of finance for that reason who brings in banks that we know are good at business acquisition. So it's really picking the right bank. It's also having a broker and a business owner who are realistic about price, because no deal will finance for SBA if there's not a business valuation to support it. The buyer is required to get one and pay for one.
Mm-hmm.
So even if you can get a buyer to accept a high price, right, that might be over market, it's still going to be subject to that business valuation, right? So there has to be a lot of kind of, blunt conversations with the seller up front that, look, you got to be realistic about the value. We can go get you a good price, but if it's pie in the sky, you're going to run up against the reality of financing, right? Especially
Yeah,
if
it's
you're that.
very similar. Yeah, it's very similar to real estate. So you're
Yeah.
buying a house, and the house you can only get a loan on the bank, $250,000 in the house, and the person wants 400K. Where are you going to get the $150,000 from?
Yeah.
Okay, it's a very similar situation, right?
Yeah.
Okay.
Yeah.
So yeah. So the holding of paper, concept of owner is selling a company. There's a buyer. Buyer has some cash
Yep.
to give the owner, but wants the owner to hold paper. And can you explain that in simple terms? What that means?
Yeah. And if you don't mind, I'm going to use an actual price
Okay.
to frame this. Let's assume we have a small business. It does, let's say, a couple million in revenue. Okay. And the owner's pulling 400,000 in pre-tax profits out of that business, whether they pay themselves in salary or it pays for a car for them or it's bottom line net income.
Mm-hmm.
It generates 400,000 in earning power in that business. Okay. Depending on industry, that business could sell for anywhere from 3 to 5 times that number. Okay.
3 to 5 times of the profit.
Yep. Of that
400K.
Yeah.
Okay.
And that gets called a lot of things: discretionary earnings, cash flow, but basically it's the earning power of the business that the owner pulls out and puts in their pocket before they pay taxes. Okay.
Mm-hmm.
That buyer could realize if they keep the business operating about the same way. Okay.
Right.
So it's got 400,000 in what we call that discretionary earnings. So that could sell for 1.2 million. It could sell for 1.6. It might even get, if it's a really attractive business, it might get a 5x multiple and sell for 2 million. Okay.
Mm-hmm.
For today's discussion, let's just say 1.5 million. Okay. I'm just going to kind of pick a middle of the
That's
road
the
number.
purchase price.
That's the price. Yep.
Okay.
So what a buyer should look at on that first is, all right, can I afford it? Can I afford it from the amount of down payment I have? But is it enough cash flow or discretionary earnings? Is that 400,000 enough to service the debt and pay me a reasonable salary for the time and risk I'm going to take?
Mm-hmm.
And there's a little money left over, so it's not so tight that if I have to buy a new piece of equipment or I have a soft quarter and I have to put a little money in, that's not going to put me on, right? Those 3 things: service the debt, pay you, have a little bit of cushion in the business. Okay. They should look at that first. So if they need to make 200 that they need to pull out to support their lifestyle, is that 200 left enough to cover the debt, right? That incurred by that business? That's the key question. But the way that debt would, in most cases, would look like is that buyer would probably put, let's say, 20% down. They might be able to put less down, but they'd probably put 300,000 of their own money into that deal. Okay, and then they would probably ask the seller to carry 150,000, maybe more if it was a bank deal. Okay, but let's say this. Let's just for easy math. Let's say they ask the seller to carry 300,000 as well. Okay, so we got 300,000 coming in of this 1.5 million from the buyer. We got 300,000 in promissory note to the seller that they'll get paid over time. We have $900,000 left. That's coming from the bank. Now, if somebody listening to this is doing the math, what you'll realize is that the seller in that case is going to get 80% of their cash at closing because they got 900,000 of the bank's money, 300,000 of the buyer's money. There's that 1.2. So the seller's exposure in that case is 20% of their price. And that's not uncommon. The benefits of that are if you select a strong buyer, you get to defer the taxes on that in most cases. Talk to your tax advisor, but in most cases,
Right.
you pick up some interest. I mean, there's a reason these banks do these deals, right? They're making some serious interest on these things. So that would be typical for carrying paper with a seller carrying 20%. That would not be unusual.
Okay. So the buyer basically the seller becomes basically a bank.
Yep.
Holding a note, basically IOU with an interest rate or amount paid per month, whatever the negotiation is, and they become a secondary source. So I'm assuming the SBA becomes the first, what is it called? First lender?
Oh yeah, yeah.
Okay. Okay.
The way our founder, when I first went through training 20 years ago, the way he explained that is the big dog always eats first.
Right.
And the SBA lender is the big dog.
Right.
Sure.
Gotcha. More skin in the game. I gotcha. So the discussion we had regarding these retirees or these corporate execs who come out with a lot of money in their 401k and their IRAs, rollovers, that they may have $500,000, $1 million sitting in there that they'd like to use money in your own retirement account used to buy a business, that there's a mechanism to do that. There's legal structures, right? I mean, there's documents have to be filed and stuff. Can you take us through that process of someone has $500,000 in their 401k, IRA, and they want to take 250,000 or $500,000 of that to buy a business? How does that even happen?
Yeah, so a lot of buyers or potential buyers aren't aware of that. So I love the fact you're bringing it up. A lot of them just don't know they can do this. And I'm going to give you the layman's version of it, okay? Because we work with partners who do it, right? But essentially, what they do is you take that 401k, you take that what they're invested in today, and they're instead going to invest that money in the stock of the new company they're buying. So whatever's in your mix right now, you pull that money out, and you're going to direct that towards an investment in the stock of the company you're buying. There are companies like Benetrends that are our partners that put these plans together. And Benetrends is actually the founder of this program and can help a buyer navigate to make sure it's proper under IRS statute and help with conversations with their accountants or their plan provider. These plan providers these administrators aren't all created the same. So I just encourage anybody considering this to make sure they're dealing with somebody who's done this for a while and really knows how to make sure you're getting that money out tax-free. That's the benefit, right? So rather than exiting your plan and taking the tax hit, you can put the entire amount without a tax hit into an acquisition. So,
right, and not going into all the specifics. I know you have to watch what you say. Not me as much. So, that you take that money out, let's say, because you can call your IRA and 401k IRA or 401k if you have control. You make a phone call and you say, listen, I want you to wire $250,000 into my account. And they'll do it. I mean, no taxes held, nothing. They'll do it. Now you have to obviously report that if you're taking the money out. But so you can get the money sent into your account directly. And then that money has to go into some kind of structure, is what I understand, some kind of corporate structure. Let's say it's ABC Main Street Co. And that money goes right into ABC Main Street Co. And ABC Main Street Co. is going to buy shares in this company, I guess, that you're buying. So the ABC Main Street Co. owns the shares of the company that you're buying, and that's kind of how it all works. We're not going into all the mechanics.
Yeah, but you're right. But think of it this way: rather than your 401k owning, Microsoft, right? It's going to own shares in the company you just bought, and you get to avoid that layer of tax in that case. And as I understand it, in most cases they create a C corp for that reason. That's part of the requirement. Mm-hmm. And they do charge an administrative fee for that every year to keep that plan in compliance and all that.
You mean Better Trends?
Yeah, Better Trends does. Oh, I think all of them do.
Oh, okay. The company that does that. Okay.
Yeah. They charge a fee for that to, make sure your annual filings are in, and that they actually will help you set up that new entity for making the acquisition to make sure you're in compliance. So before anybody moved anything out of their funds, I'd suggest talking to a company like Benetrends and say, all right, what does a plan look like? What do you do for me to make sure I'm in compliance? And I think Benetrends still does this. They actually provide a guarantee on theirs that if you ever get a letter from the IRS, that they provide their attorney to help with that conversation to show that you're in compliance, right? Because you don't want to take that tax hit, obviously.
But of course, that's the whole point. Hit you with 10% penalty and your tax bracket on top, whatever that is.
I will mention this too. They recently rolled out another plan that has some advantages when you exit your company. So, all these buyers are someday going to be sellers too, right? So when they go to sell, one of the biggest problems they have is, up to 30% or more of that purchase price might have to be paid to the IRS. So you take a big hit on that sale price. Benetrends introduced some programs that mitigate some of that tax as well by setting up plans that allow that to channel through those 401k programs and avoid some tax. So I'd also encourage anybody out there thinking about that to ask about that plan as well, because you might be able to avoid a 20 to 30% tax hit when you exit your company 10 years from now.
Wow, not a good point. Thank you for sharing that. Staying on the financing track, I think that's valuable that people like to know about that. I've seen across my feed, I get emails, I get direct mail about these people throwing on these seminars and workshops about buy a business with no money down, and all these kind of things, and it's basically selling you a training class, right, or some software or some CD, video things to teach you how to do this. But I guess my question to you, obviously you're doing this day to day, how real is it to be able to buy a business with 10% down on a purchase price? I mean, clearly anybody who's reasonable will say, I gotta have to come up with some cash to do this. Okay, I'm not gonna walk into a business and get 100% financing and have some skin in the game. So how realistic is that? Somebody can come in and say, okay, I see a $500,000 business. I'm gonna put 50K down, and 90% is coming from somewhere else. I don't know how that is, but how is that possible?
Yeah, it's doable. From a standpoint of only having 10% come from the buyer. It's not doable though if you're saying that that's all that the seller is going to get. Okay, so using that example I talked about earlier, I'll use your $500,000 example. It is possible with an SBA loan that a buyer could pursue a purchase price and close on a purchase price of $500,000 and only spend $50,000 or $60,000 of their own money. And if they have a good credit score, transferable experience, the SBA will sometimes let them in for as low as 10% down. Okay, and in that case, there might be another 10% coming from the seller in that seller financing we talked about, or 20%, let's say. But if the business cash flows nicely, and the bank looks at the what they call their debt service coverage ratios, they'll let that happen. So as low as, I think 10% is the lowest they'll go. And again, if you have a good credit score and transferable experience, and it's a good business, you can get in for as low as 10. So
the SBA only goes up to 80. Is that it?
Well, they will do 90. They will do 90%. Okay. The only reason I always talk about the seller financing is it's very common for it to come up. But we've done many all cash deals where a buyer brings in 10%, the bank does 90%, and the seller gets cashed out. But most buyers ask for it, and you have a better chance as a buyer and seller of the deal getting through underwriting if there's a little bit of seller financing. And seller financing just solves a lot of problems, right? So if a buyer is worried about a certain contract they're assuming or a piece of equipment, or will the seller answer the phone after close to help them with issues? If they know the seller has a little bit of skin in the game,
Yeah.
right, they just feel a lot better about that, and the bank feels a lot better. So even if the buyer and the bank love it and would cash it out, buyers still need to have a little bit of seller financing.
Well, that's good. That's good. And obviously, many business owners don't realize what their business is worth, right? So in order to get financing, you have to have, if you're selling it, you have to have some kind of sense of business value. So you can put a price on this thing, right? And for people who are listening, at least for what I understand, is when you're look at the profit of your company, and you use the example of, say, if you're making $500,000 in profit every year in the business after everything's been paid, you multiply that times a multiple, meaning like 3 times earnings, which is the 500. So that business is worth 1.5, right? And right, certain industry verticals may go for 8 times earnings, 9 times earnings, depending upon what it is. But typically 3 to 5 is the number I'm always hearing, typically in service businesses and things like that. So that said, in order to come to a price, you have to have a business valuation.
Yeah.
What is the business worth? And there are people like you who are trained to do this kind of stuff, right? Yeah. Okay, go ahead.
Yeah. So you're touching on the number one question we get, which is, what is my business worth? Right. So we over the last 20 years, I think that's the question I've heard the most from a business owner and our brokers and M&A advisors here, because you really got to stare before a seller can make a decision. So we offer a complimentary value range at Sunbelt, and we'll sit down with an owner, usually look at 3 years of financials, and we'll figure out what it really makes, not what their tax return says, right? Because they're all filing their taxes to mitigate taxes. That's their accountant's job. Like, what's every legal path I can take to write something off? Well, if you hand last year's tax return to a buyer, good luck, right? Because it doesn't tell the story, right? It doesn't talk about, the 3 vehicles that were run through it, and the sports ticket, the baseball tickets, and the trips or whatever has been run through it. For your 401k contributions, your salary, all that. It's just going to show probably a fairly modest net income number. So the first thing we do with the owner is say, look, what are all the ways you pull money out of the company? Well, I pull 50,000 out here, and it pays me 100,000 here, and pays for my vehicles, and I contribute, I bought some stock over here, whatever it is. And that's that discretionary earnings number we talked about. Sometimes you'll hear it called EBITDA, but the fact is you got to get that discretionary stuff in there too, right? That's our earning power, like you referred to with the 500,000. Then we look at the industry comps. We get into some of our proprietary databases and go in there and say, all right, we're looking at a contract manufacturing company. It's in CNC metal manufacturing. Let's look at the last 10 transactions we did and look at some of the third-party databases. What are they going for? And then, does this company deserve a premium for that because they have some great value drivers? Or maybe that should be discounted because maybe they just lost a customer and it's real owner-centric and their financial trends are down. Then we might say maybe the price has to be lowered a little bit, right? So it's kind of a quality factor in there too. Like in your example of 500,000, 2 companies that are in the exact same industry that both make 500,000 might sell for vastly different multiples based on how well run they are and how quality they are in the way they run their business. I don't know if that makes sense, but.
No, yeah, I get it. I mean, yeah, it makes sense. And I guess from a valuation perspective, that if you're a business owner and you're running, like you say, all these expenses through the company, because you're trying to mitigate your taxes, reduce taxes, all that money, cars, phones, 401k contributions, of all the travel, all that gets put back in. You're spending 50 grand a year on all that, gets put back into the business as cash, right?
Yeah. Yeah.
And that goes back to your bottom line, raises the valuation of your company, because when they buy it, that stuff's not going to be there because you ain't getting that. So,
Right.
you know,
Yeah. I mean, yeah. The buyer's not going to keep paying for your car for you.
right, exactly.
So it's a non-operating expense going. The business doesn't need it. The test is this: does the business need it to create revenue?
Right.
Does it need it to operate? If it's a non-operating expense, it's just at the kind of the discretion of the owner.
Right.
For the owner's benefit, add it back in almost every case.
Exactly. So we add back that money, and that goes to the value of the company.
Yeah.
The other issue that caught my attention was what businesses now. We're having this discussion in June of 2020, and what's going on with the pandemic across the country and the world. What businesses are, and it may be beyond this as well, even when we get out of it. What businesses right now are good to buy, ones that could be in distress just because of the market of what's happening. But once the market shakes out, they'll be back to normal. So where do you see opportunity when you see all this data coming across your feed? I'm sure you see a lot of data that I don't, and a lot of people that are watching this are going to be hearing it don't see this data. I see trends across the country in different areas, but I'd love to hear what you see in opportunities.
And that's a burning question right now, right? It changes daily, and it changes by geography and what certain mayors or governors are doing, and what our elected leaders are doing. And there's an article. If you don't mind me mentioning our website.
No, go ahead.
We have a blog post on there, sunbeltmidwest.com. And the blog post is called Corona Sensitivity. And it talks about this issue. And the concept's basically this: the more corona sensitive you are, and it's kind of a duh, but the more corona sensitive you are, right, the more impact it's going to have on the sellability of your company and its potential value. And I'll give you an example. We have a food manufacturer right now, and food manufacturers in general are doing very well. Okay. But this particular food manufacturer has a big client mix of restaurants, mostly in the Midwest. Okay. And their clients are shut down. And these are fresh goods that they're supplying, right? Not like canned goods. So they're a food manufacturer of fresh goods to restaurants, right? So effectively, their spigot turned off. Now, that's been the case for them for 3 months. Restaurants are starting to open back up here. In another month, they believe they'll be back up to their pre-COVID levels. So there's that reality. And then you say, okay, well, we're in a post-COVID world, but what if they decide, what if the powers that be say, well, we're going to shut down again? How do you account for that risk? So business prices are heavily impacted by risk. At the end of the day, that's what it comes down to. The more risk you have in your business, as that risk goes up, your price comes down. Vice versa, the more growth opportunity you have in your business to grow, and if you're enjoying strong growth, your price comes up with that. So risk drives price down, growth trends or growth opportunities that are being realized, right? Not like pie in the sky, right? But are being realized will drive price up. So what we're seeing is very corona sensitive businesses like travel, hospitality, all the stuff you would expect, restaurants and bars, are not only being impacted on their price, but many just can't be sold right now. There's just too much uncertainty until they open back up. And an example of that would be another deal we have right now. We delayed the closing 2 months. It was childcare related, and they said they were closed down. The owner actually didn't have to, but they decided to. So the deal was the buyer said, look, when you get back to normal, I'll close, right? And they didn't discount the price because they don't expect it to happen again, okay? Now, outside of corona sensitivity and COVID shutdown issues, usually the companies that are the most popular are B2B, e-commerce, managed IT services, trucking, manufacturing, distribution, B2B services. Those folks get the highest multiple Okay. Retail, food, and business to consumer um, often have, unless it's a manufacturer or a consumer good, but if it's like a retail based front and it's not e-com, usually get lower multiples. They might get 2 to 3 multiples for those kind of companies, whereas manufacturing regularly gets like a 5x multiple.
Wow. Yeah,
Yeah.
so corona sensitivity, I guess, or COVID sensitivity, all those industries that were impacted by the coronavirus, I guess. Take taxi companies, for example. You know,
Yeah.
people weren't going anywhere.
Right.
They're sitting on vehicles, right?
Right.
Avis, I don't know if you heard something about Hertz, was having some serious problems that they're probably not going to go bankrupt, but they are, they got some serious issues with those cars. They have all those payments, and the cars are not going out because nobody's flying. So
Yeah. And think
sounds
about that.
like, I'm sorry, I got sound. Let me finish. It sounds like cars. Those
Yeah.
cars are going to show up on the auction block. That's going to show up in retail car dealerships.
Yep.
So sounds like maybe some opportunities in the car business on the
Yeah.
low because Hertz got to get rid of inventory. I'm sorry. Go ahead.
Right. No, you're absolutely right. And what that illustrates is it ripples throughout the economy, right?
Mhm. Yeah.
So when Hertz has these issues, or the airlines have issues, or whoever has issues in these industries, who's in their supply chain, right?
Mhm.
So that's a question we're asking all of our sell side clients right now is like this food manufacturer. If you serve the restaurant industry, or you serve the travel industry, or if you serve the car rental industry, which is in the travel industry,
Mhm.
you have that risk too. So
Right.
if I was a buyer or seller listening to this right now, if I was a seller, I'd say, how diversified is my customer base? Am I in high risk categories?
Mhm.
If so, what am I going to do about it? Because it's just like if Walmart's your only customer, right? Well, that's great while times are good, but if they turn it off, do you have a business left? Well, it's the same thing here. If you're in an industry that is corona sensitive and the government shuts it down, life
Mhm.
is going to be rough.
Right. Right. I know, absolutely.
Make your business maybe unsellable.
Yeah, no, absolutely. I agree with the assessment here. There's all opportunities in Corona sensitive businesses, the COVID sensitive businesses. The question is that can you take that leap, buy one that's really struggling on the cheap, if at all possible, then you got to be able to bite the bullet while it's getting ready to come out, whenever that is, and that's the risk.
Yeah,
Yeah, can you buy, let's say, a motel,
yeah,
a motel, with 50 rooms, and that's hurting because they don't have customers because nobody's coming. But
yeah.
can you cover the mortgage and
Mhm.
that business while you're
Oh,
waiting for it to come
absolutely.
back up?
Yeah, so I'm looking across our parking lot right
Yep.
now,
Yeah.
and I'm looking at a Delta Marriott that I know they put 14 million in recently to renovate, and there's not a single car in the parking lot because the whole place and the restaurant are shut down. Okay, it's a great place. I mean, people want to go there,
Mm-hmm.
but shut down. Now, I'm pretty sure it's an individual owner flying the Marriott flag over there. So, and if they don't have the money to tough it out, my guess is they'll have to sell it, right, to
Mm-hmm.
somebody who specializes in turnarounds and buying distressed assets. So both small investors and big investors can benefit from that.
Yeah.
But then you got to get back to, okay, how much cash am I going to have to burn to wait it out? What is the plan? Can I return it to normal? Right. And again, we don't take a lot of those to market.
Yeah.
We have several asset sales right now we're representing, but we don't go pursue them because they just are harder. A good cash flowing business priced reasonably, we're going to sell it because our database of buyers is so big after 20 years and our ability to reach them.
Mm-hmm.
Distressed, you got to find kind of what I like to call a cowboy or a cowgirl,
Right.
somebody who's very entrepreneurial and is like, all right, I've got some capital, I can fix this thing, and it doesn't intimidate me to go do it. I got the team to do it, or I have the experience to do it, and yeah, we can get this thing back, and they can get very nice price for it.
That's great. So when you're not, being a master king deal maker here, making the buyer and seller come along and let's make this deal happen.
Yeah.
What are you doing for fun that takes your your mind away from working the hours that you work, whatever that is, and what do you do for fun?
Yeah, I mean, it is. It's a stressful job, so you got to find ways to, like any business job. I mean, it is kind of like you got several roller coaster rides going on every day because these are complex. I spend a lot of my time with our brokers, helping them with deals. I don't do as much deal making as I used to, because we've got 30 plus brokers here. So my door is pretty busy with people coming in saying, "Hey, I got this issue or that issue on a deal." But when I'm not doing that, I like to mountain bike, I like to hike, like to travel. Got out to Ireland and Alaska and Mexico last year.
Oh,
so
you.
before the shutdown happened. So, yeah,
Yeah,
love to get travel in when you can, when they allow you.
Right. Okay. Well, that's good. So that's something you like to do and travel and ride a bike, and so something liberating about riding a bike, and just the air in your face and just clear your thoughts, right? So do you ride with music or you ride no music?
That's a good question. So I mostly mountain bike now. So and like I used to ski when I was younger and in better shape, but the mountain biking I do, you got a lot of twist in the trail, right? So I do like music, but when I ride, but what I really like about it is it really allows you to kind of tune out work, because you have to pay attention, otherwise you're going to kiss a tree, right? So you really it takes your entire attention to deal with it, to make those turns and come up with the berms and stuff like that. So to me, it's kind of like a meditation. It's a good workout, but also, I can't think about work while I'm doing it. So that's nice.
Oh, that's good. Yeah, it's like you're driving a standard and you can't text or you can't talk on the phone if you don't have an earpiece because you're
right.
You're doing all this.
yeah, exactly. It's gross. You have to use all your attention span to deal with it.
That's right. So you drink coffee, hot or cold?
Wherever I can get it, as long as it has caffeine, I'm good. Yeah. Cold coffee, hot coffee, Red Bulls, anything with caffeine in it. I'm in.
A hot dog with ketchup or mustard?
Ooh, that's a charged question.
Yeah, I know.
Right? Yeah. I will do it with both. Sometimes I will admit I will do it with both. Most of the time, just mustard or a coney with everything on it. You get some of that chili on top, onions, peppers. Load her up.
I gotcha. A hamburger with ketchup or mayo?
Boy, it's gonna have ketchup, mayo, mustard, lots of pickles, and a lot of other stuff on it.
Yeah, throw all those flavors in together and get all that going. Okay, I got you. Good for you. When you're when pre-COVID, when everything was somewhat normal, were you watching? Are you a Netflix, Amazon Prime person, or did you like to go to the theater and see the actual movies?
I love to go to the theater with my daughter. She loves the theater. She's grown now, but that's kind of our thing. So if there's a good movie out, with good special effects where the theater really pays off, we do that. So I like that. Other than that, I enjoy watching Yellowstone right now on streaming. And I don't know if you watch that show, but
I have.
I really
The second season, I think, just started, right?
Yeah.
Well, the first season.
The whole second season's out there right now.
Okay.
Yeah, but that is excellent.
Yeah, it makes you want to buy a ranch in Montana, doesn't it?
Yeah, at first, but then after watching it for a few episodes, it seems like the most dangerous thing in the world to do.
Yeah, well, right. It's more city life down there if you think about it. Than country. So, Apple or Android?
Android, much to my daughter's chagrin. Yeah.
Oh, she's iPhone, Apple.
All three of my kids make fun of me because I have an Android and they all have iPhones. So
yeah, smarter people do Android. That's all I gotta say. I do Android.
Yeah.
Do you wear a wristwatch or you just use your phone for a watch? There you go. Wow. Yep. You are one of the rare there's a lot of men who do wear watches, but a lot of them are not wearing them because they have their phones.
Yeah.
So yeah,
I like to have it. I'm just used to looking at the time that way. And I also, if you're in a meeting, it is very hard to politely check the time on your phone. In my experience, it's a little easier to watch.
yeah, you can be a little bit more discreet by by kind of glancing versus looking at your phone, which is obvious.
Yeah.
So and if you had any place to go, ability to go anywhere across the world, do anything, money and time is not a problem, not an issue. Where would you go?
And this is just for travel, like what my next trip would be, or
Where would you go? Anywhere. Yeah.
Oh boy, that's a big one because I've been thinking about that. I think right now it would probably be Australia. Australia would be the next one, or the Mediterranean. One of those two.
Okay.
Both are at the top of my list for travel right now.
And last question to round us out: if you had one superpower that you were given, what would that superpower be?
You got to go with flight, don't you? I mean, you got to go.
Want to be able to fly?
Yeah. I mean, come on. Like, people dream about that, right? I'm going to start with that. And I feel like I could turn into a business somehow, right? I mean, advertise on the Cape. I don't know. You could do. Yeah.
Gotcha. Well, share your website once again, Chris.
Oh, thank you. Sunbeltmidwest.com. Yeah, and there's lots of great blog posts on there if anybody's looking to get educated on seller and buyer content. A lot of good stuff.
Absolutely. We've been talking to the Chris Jones today, the president of Sunbelt Business Advisors out of the Twin Cities of Minnesota, talking about buying businesses, selling businesses, evaluating businesses, financing the acquisition of businesses, using your 401k IRA to fund the business if you didn't know about that, and what opportunities are in the marketplace right now. It's called COVID sensitive businesses, where you may be able to take advantage of an opportunity and buy a company that's out there right now, if maybe at a good price. So we thank you for listening and watching. We thank you, Chris, for coming on and sharing some of your knowledge with everyone. And I love the conversation. You're doing some very interesting things. It's an interesting business. And thank you so much for sharing.
Thanks for having me, Gil. I really appreciate it.
You're welcome. All the best to you, and go out there and make it happen, buddy.
Absolutely. Thank you.
Be well. Bye-bye.
Have a good one.
All right.